Good morning and welcome. My name is Philip Field. I'm the Lead Ombudsman for Banking and Finance. I'll be doing Theresa May impersonations in a moment. I'm the Lead Ombudsman for Banking and Finance at the Australian Financial Complaints Authority, and I'd like to begin by acknowledging the traditional owners of the land upon which we meet and pay my respects to elders past, present and emerging. Welcome to the first AFCA Banking and Finance Forum. And I guess technically, because we're talking about FOS statistics as well, the last FOS Banking and Finance Forum. It's nice to see you all here this morning, and we are joined by thousands of people around the country. I like to exaggerate sometimes, but certainly quite a few hundred are joining us online as we're streaming this as a webcast. So I have a few housekeeping matters to deal with in terms of the housekeeping. So those of you who are watching online, if you have any technical difficulties with the webcast, you can call technical support on 1800 733 416. Any of the AFCA resources on today's agenda can be accessed via the resource library down in the bottom right-hand tab. And if you have a question for the panel, click on Ask a Question and type it in, and we've got a little iPad up here where your questions will come through. We'll also be taking questions from the floor, and we have some pre-prepared questions in case nobody really wants to ask a question at all. So, a bit of an AFCA update. The Australian Financial Complaints Authority received authorisation from the Minister for Revenue and Financial Services to establish and operate AFCA. AFCA will commence on the 1st of November, so only a few more sleeps. All financial firms are required to hold membership of an external dispute resolution scheme and had to join AFCA by no later than 21 September. We're very pleased to welcome our new CEO and Chief Ombudsman, David Locke, who started on the 25th of June. And of course, the AFCA rules and operational guidelines are now available on the website www.afca.org.au, and they've been approved by ASIC. So we're ready to go come 1 November. Of course, we also have a new board. The inaugural board assumed responsibility for the implementation of AFCA on the 4th of May, and the board comprises an independent chair, 4 directors appointed by the Minister, and 6 ongoing directors from the Australian Financial Complaints Limited Transitional Board and the FOS Board, and they're the names of the industry and consumer directors, and the chair is, of course, the Honourable Helen Coonan. So just a bit of a background about where we've been. So in June 2018, we started consulting on the AFCA rules, which are also known as the terms of reference, but they're called rules going forward. We also, in July, consulted on the AFCA interim funding model. Last month, we released the final rules. We've been providing information to various stakeholders about the AFCA dispute resolution process. In September, had to join AFCA. 1 November, we start dealing with disputes. Our website will be up and running, new AFCA website will be up and running to take complaints from the 1st of November. We've also been out consulting about the funding model. There are 3 phases. The funding model for the period 1 November through to 2020 has been released. We'll be looking at our experience about the disputes received, and the board will be reviewing the funding model in due course. But that funding model is available on the website, and if you need more information about that, you can contact funding@afca.org.au, or you can call our membership team on 1300 565562. Or as I said, you can check it out on the website. So one of the more significant changes with the introduction of AFCA is a change in the claim limits and compensation caps. And certainly in the credit and banking area, probably the most important ones are, for most complaints, the amount of compensation that can be awarded is $500,000 with a monetary limit of $1,000. So that goes up from 323,500 to 500,000 for compensation, and 500,000 to $1 million for the amount of the claim. And in small business, some significant changes. So there was a facility limit of $2 million. That goes to $5 million. So you can have more than one facility, but if they're all under $5 million, that small business can still bring a claim. The definition of small business changes too to be up to 100 employees, so no longer a distinction between manufacturers and non-manufacturers. And if you're a primary producer, that is a farmer, then the facility limit is again 5 million, but the compensation cap, it says there 1 million, but I think it's 2 million. So it's quite a significant difference. For those of you who subscribe to the Code of Banking Practice, the new Code of Banking Practice will have a definition about small business, which is substantially different. We will continue, as we have in the past, to say that the obligations to small business in a code represent good industry practice, and we will be applying that to any small business dispute that we deal with. So just bear that in mind when you're dealing with those sorts of disputes. The other change is around a claim by a guarantor where the security for that guarantee is a person's primary place of residence. There is no cap on that. So that effectively means if you've guaranteed a small business or a family member or some other person, then if your house is on the line, then you can bring a dispute to AFCA. So it'll be exciting times, challenging times. There'll no doubt be a few teething issues as we bed those things down. I've been asked this morning, are we expecting a flood of complaints on the 1st of November? That's a really interesting question. There will of course be some people who will wait and lodge under the new limits. But I think probably we're not going to see a significant flood, but it will be I think a slow burn in that as people become aware of the new jurisdictional limits, more and more complaints will be lodged over time. But your guess is as good as mine, I suppose. But I expect there'll be a bit of a increase come 1 November, and then things might settle down a bit. But of course, whilst people will be lodging complaints, financial services providers will be making greater efforts to resolve disputes early, and indeed without AFCA needing to be involved. So hopefully a combination of those things might actually see our dispute numbers fall, because you'll be doing a much better job of resolving these things. So that's my introduction, and I'm going to ask Diana Ennis, our Executive General Manager for Resolution, to talk about last year in review. And I think, Di, you're also going to talk about some AFCA process issues as well. So thank you very much. We hope you enjoy the presentation this morning. If you are online and you have questions, please feel free to type them through, and we'll get to them hopefully towards the end of this morning's session. So thank you, welcome, and enjoy.
Thank you. Welcome everyone. And for Troy, who's online asking if this is going to be on our website, yes it will. So Troy, if you've got a meeting to go to, feel free, because you'll be able to see it later. Thanks, Philip. As Philip said, as EGM for resolutions, my role is responsible for operational management of the day-to-day dispute resolution process at FOS, has been at FOS and will continue to be at AFCA. So my focus today is really with two hats on. First of all, it's the FOS year in review, and I'm still trying to get rid of this, get used to all this new branding, because I'm looking at that slide thinking they're the different slides to what we've been. So this is FOS in review, but here is our wonderful new AFCA brand, which we've released last week. So what I'm going to do is really, it's quite momentous because it's the last time we'll be talking about FOS statistics. So many of you in the audience will think, great, because it's statistics at 10 in the morning, really, who wants to know? But I'm going to tell you about them. And they're the stats that came out of our annual annual review. So they're all on our website. So what's it telling us? What it's telling us is what everyone in the audience knows, that I think everybody in the room's been incredibly busy. We've had dispute volumes up. They've been up by 11%, but we've also closed record closures, so they've been up by 10%, our closures. The other thing to have a look at is hits to our website, so they were up 20%. It's not surprising given the current external environment that we're all in, and it'll be interesting, I think, as times move forward, we'll see that increase over time. In terms of phone calls handled by our contact team, these are the stats for the 1 July 17 to 30 June 18 year. That will be significantly up next year because the getting members transitioned across to the new organisation from the predecessor schemes has been a significant impost with staff trying to make sure that we can support people on the phones. So who did we see lodging disputes in the last financial year? 77% of people were over 30, and for all the women in the room, the people that complain most in life are men. So even though men deny that, and I keep this in my back pocket every time I have a discussion with my husband, it's statistically correct because 57% of people that complained were males. So there you go, Philip.
It's only because their wives told them.
More for them. So anyway, that's where we're at. And look, it's not surprising that the two largest states in terms of population had the largest spread of complaints. So more men in Sydney complained and more men in Victoria complained as well. How are most of the disputes coming into FOS? 76% came in online through the online dispute form, and I find that statistic quite interesting actually because we've had an online dispute form for a number of years now, and it's pretty much stayed consistently at about 75%. I would have expected with people using the internet a lot more, you might have seen more, but that's probably also an indication of our need to be accessible and really reinforces how people need alternative mechanisms to come in and lodge a dispute. But overall, 91% come through either internet or email, meaning that most of them are through online mechanisms. Disputes received. You'll see there that it's the first time in the history that we've received over 40,000 disputes, so it's just under 44,000. In the 2018-2019 year, we're expecting to receive around 55,000. So it might be our one and only year of hitting in the 40,000 mark. The main increase over the last financial year was a 28% rise in investments, and 27% rise in deposit-taking disputes. So I think a number in the room here will acknowledge they've seen that in their areas as well. 44% of disputes were resolved at registration and referral, and traditionally amongst credit members it's around 48 to 50% that are resolving at registration. So that 44% takes into account general insurance, investments, life insurance and credit, deposit taking and payment systems. Disputes accepted. So disputes accepted are those disputes, they've come in the door at registration, we've referred them back to your EDR areas, you've hopefully resolved 50%, we'd like you to be resolving 60 to 70%, and then they come back and they get accepted and they move through into our case management system. So in terms of the banking and finance type disputes, 57% of all disputes that move into case management are banking and finance related disputes. So it is a significant proportion of the volume of disputes that were received at FOS. 36% of them went through fast track and 40% went through standard and complex. We've got terms of reference there showing that 24% went through there. It'd be interesting to see that over the next 12 months because a number of disputes have been gone through terms of reference and in the past have been excluded because they've been referred to another more appropriate place, so either the SCT or either the Credit Investment Ombudsman. But given we've now got one single scheme from 1 November, we would expect that figure to actually drop in the coming year. Disputes closed by outcome. So what you can see is that 91% of disputes get resolved before a decision. My maths, I'm not known around the office for my brilliant maths, but even I can add up 6 and 3 at decision status gives you 9, and 9 from 100 gives you 91%. So there you go. What that means is that a lot of disputes are resolved by mutual agreement, and really that is the preferable way, as we all know, for customer satisfaction, for people to be a lot more satisfied and for you to have an ongoing relationship with your customer. 14%, you'll see at the bottom outside terms of reference, again, that's a figure that's really likely to drop. And when you look at the 24% on the page previous, that shows that 10% go through that terms of reference team that then move through to case management. So they're actually not excluded. A lot of the disputes that go into that team are because members have objected to jurisdiction. It may be that part of the dispute is excluded, but what it shows is that not all disputes that you object to are excluded. What the annual review does show, and it's not on this slide, is the average time in the 17-18 financial year to close disputes was 54 days. So I know there's a question coming up about resolution timeframes. 48% closed in under 30 days, 80% in under 60 days, and 87% in under 90 days. So that leaves only 13% of those 44,000 disputes that took more than 90 days to resolve, which, given our increase in dispute volumes and all the work everyone's got on with a Royal Commission focus, I think has been quite a good outcome for the year. So in terms of credit disputes, I'll go through a little bit more about your sector, because the first section of those slides were holistically across all of FOS. Just over 11,000 credit disputes have been received. I know that that was a challenge for us at FOS over the year, is trying to keep on top of our volumes in the banking and finance teams. Fast track and more recently responsible lending disputes in the Standard and Complex area has been a challenge. So the vast majority of the credit disputes related to consumer credit, and the most common issues were financial difficulty at 27% and a decision made by an FSP at 25%. But you can see from that chart there that in 17-18, it's the first time that we've hit over 10,000 for consumer credit disputes. Business finance will be an interesting one. That was 9% of the total disputes received in the last year. So it'll be interesting to see how changes in jurisdiction over the coming 12 months impact that figure and what difference we see in terms of those volumes being received. What I can say though, which as I mentioned just before, is responsible lending is on the way up. Consumer credit, so those 10,000 that was received, 40,000 were about credit cards, 27% about home loans, and 19% about personal loans. So a lot of that being responsible lending on those particular products. Banks were involved in about 71% of those consumer credit complaints. Business finance, so we only received just over 1,000 business finance disputes in the 17-18 year, about 2/3 related to business loans, followed by business credit cards. And FSP decision and financial difficulty were the two largest issues that we saw in those types of disputes. Guarantees, and again Philip just mentioned the change to jurisdiction with guarantees. It'll be interesting to see how that has changed. Over the last few months with changes to jurisdiction, if we've seen a dispute come in where the amount of the guarantee would have fallen under the new rules, we have contacted parties and particularly some of our members to say, were they prepared to consent to us looking at it? We haven't had a huge volume of those disputes coming in, so I'm not sure that we're going to see, as Philip referred to before, floods of disputes coming in about these. What I would say though is that in October, for both the Melbourne office and our Sydney office, and Sydney's still operating under the CIO rules, we have seen a significant increase in dispute volumes for the month of October. It's probably no surprise to you because that means you would have seen them a little bit earlier. But we have had 230 guarantee disputes in the last financial year, 48% relating to consumer guarantees and 37% to business guarantees. Deposit taking disputes, just over 2,000 were accepted. The main categories that we saw those issues in were current accounts, including business transaction, foreign currency, mortgage offset, passbook and personal transaction accounts, and then savings accounts were the other ones. Most common types of issues were disputed transactions. So 40% were about disputed transactions, and I think the two adjudicators sitting on the table up the front would be nodding with this. Neva Skilton and Rachel Ehrlich, who are our adjudicators in the fast track team, and they would have seen and have been seeing a lot of unauthorised transaction type disputes, with the more complex ones as in where there are multiple disputed transactions going through to standard complex. But 97% of the ones relating to the disputed transactions were with banks, so I think that was quite an interesting figure. Financial difficulty, about 99% related to credit products. So we accepted just under 3,000 disputes relating to financial difficulty. And the most common issues were failing to respond to a request for assistance, which was 33%, which is up 10%. Whether or not it's a factor about resourcing for your internal dispute resolution areas, and I hasten to think it could be a factor in it. If you're not getting back to people about requests for assistance in your particular IDR areas, it's often as a result of having a lot of inflow of disputes with not enough time to get to them to meet the timeframes. So then they come to FOS, or did come to FOS in the last year. Next year, this year will be AFCA. So really, your resourcing in those areas is key and critical to make sure you are responding to those requests, because I think, to be honest, 33% is not really acceptable in an industry that should be able to deal with people in financial hardship promptly. FSP declining financial difficulty assistance is 33%, which is down from 52% in the previous year. In terms of the main products where there's financial difficulty, it is the consumer credit facilities, and 33% relate to credit cards, 33% to home loans, and then the 24% to personal loans. So that's pretty much the final time anyone will be talking to you about FOS statistics, which is sad in a way, but it's exciting because we are now moving into a new world of AFCA with a one-stop shop for financial complaints in Australia, which I think is an exciting time. It's a great time for consumers to be able to just go to one place to have their matter dealt with, and our focus is on providing fair, independent and effective solutions for financial disputes. So what we've been focusing on the last few months is building capability in our teams to deal with the additional superannuation jurisdiction, to make sure that we've got the staffing and resources on deck to deal with the volumes of disputes that we're predicting, and to also build on a lot of the good work from all the predecessor schemes. So there has been a lot of good work done over the years by each of the predecessor schemes, and I think the thing is to take the best out of all of that and move forward into a new environment of AFCA. So what I'm going to do now is step you through some of the things with our new AFCA dispute resolution process. What we're focusing on at AFCA is outcomes. So we're looking at solutions. Our underlying philosophy is no surprises, be that for members, albeit for consumers, so that when they get an outcome from AFCA, they understand where we've come from, they understand what we've taken into account, and they understand how we reached the view that we reached. That doesn't mean we'll always agree with everyone about the view. We can understand sometimes consumers don't necessarily agree with an outcome that they get from AFCA or from any predecessor scheme, nor do members always agree with what the outcome is. But I think the main thing is for our focus is to be fair, balanced and considered in our outcomes and make sure that we've been clear and transparent in getting there. So one of the things I think that's also really important for all members is to make sure that there's open lines of communication and that there's transparency and honesty in all of our dealings. And I think one of the key things that's come out of the Royal Commission has been there's probably been some blips along the way with that. That's something that everybody in the industry needs to focus on, because we need to rebuild trust for consumers to make sure that they do have trust when they're dealing with their financial firm. For some of you, I'm not sure if you actually logged on to our webcast on Process. Does anyone want to show hands if you've logged on to the webcast that we had that is on our website for Process? So there's a few of you. I'm not going to go through in as much detail. I apologise up front if some of this stuff is a repeat. But for those of you that haven't, we've actually got it on our website in different sections. So if your staff want to go and see something about what does the preliminary assessment stage look like, when they get a dispute that gets up to that stage, they can actually log in and just look at that section of the webcast. So make sure it is on our website, so staff will be able to log in and do that. What I am excited about, tragic as it is, stats and being excited about a one-page spreadsheet. I think you've all got this on your seat with our brand new colours. What this does is give you the complaint resolution process in a page, and it's really handy. If there's spares around, feel free to take them before you leave today, because it's quite handy to take back to the office to give staff. They can pin it up if you're, allowed to have some paper, even though we're all meant to be electronic and not have any paper on our desks. But you can stick it up, and it is a handy ready reckoner just to have a look at overall time frames. So feel free to grab any spares that are left over. So I'm going to go through our framework, all the different stages, and I'll skip over a few things so that I meet timeframes and we can move on to the next session. So where have we come from? Philip covered this a little bit, but the Ramsay review got us to the legislation, which got us to AFCA being authorised in May. ASIC's released the new regulatory guide RG267, which is about EDR obligations, and that will replace RG139 for disputes lodged post 1 November. Regulatory Guide 165, which is about your IDR obligations, will go through a period of consultation with ASIC in early 2019. I understand they're going to be sending out that consultation, I think, around January, I think they've talked about, and there'll be an opportunity for everybody to make submissions. Then you get to the legal framework in which you are set up, which is as a member, bound by the terms of the AFCA Constitution and your membership contract with AFCA. So there's that contractual obligation to meet your obligations under the AFCA rules and operational guidelines, and to meet and comply with any outcomes delivered by AFCA as required. There's new operational guidelines which are on our website, and for anyone in the room who might also transgress across to superannuation complaints, there's a transitional superannuation guideline which is up on our website that assists anyone with trying to navigate differences between lodging a dispute at the Superannuation Complaints Tribunal and interpreting that in the rules moving forward at AFCA from 1 November. So how did we get to our new process? There was a joint working group set up where all the predecessor schemes were invited to participate in that joint working group, and they came up with some best practice design principles to underpin the process development. So a lot of those design principles are things that have been set out in regulatory guides. They're also set out in the legislation that is the foundation of AFCA. So I don't think any of them are going to be really a surprise to anyone in this room. Fairness, natural justice, accessibility, engendering trust, simplicity, consistency with flexibility, timeliness, efficiency, transparency, and effective engagement. So our process, despite this looking linear, do not be fooled. It is not a linear process. So we don't go through every single step like this to get to an outcome. We use this as a model to get to where we need to be depending on the circumstances of the particular case. So it's just easier for a diagram to put it in a linear format. Disputes come through registration, referred back, they go through to workflow. Workflow where we work out whether it goes into the rules team. So there's some change in terminology. It's a complaint now, not a dispute. It's rules, not terms of reference. So it goes into the rules team, if required, and review jurisdiction. If it's not required, it'll go into the other streams of fast track, standard or complex financial difficulty. Then goes into case management. There's the negotiation, conciliation, or if it can't be resolved, preliminary assessment, and then ultimately a decision. In terms of the registration and referral system, for those members that have previously been a member of FOS, there's a lot of similarities with that referral back process because it's something that's been in play for some time. It's quite new for superannuation trustees. They've not had a referral back process, and it was slightly different, I think, for the Credit Investment Ombudsman members in a little bit of a different way in terms of there is a dedicated registration team that is dealing with those disputes or complaints. Even I have to learn to change terminology. So you'll get an email notification if there are any queries about whether you think the complaint should relate to your organisation. You've got your 5 days to come back and say, it's not us, we think there's a mistake about who it's been lodged against. Any queries about jurisdiction, you can raise them at that registration stage. If you do, you bypass the balance of your registration referral timeframe because it progresses directly into the rules team for a review. And then if you come back to us and say that you think you've resolved the matter with the complainant, another new term, then we will go back to the complainant to say, is the matter resolved? If the complainant says, no, it's not, we will continue to progress the dispute, even if you think the complaint's been resolved. I'm going to get there. Man, it was easier. I was in Sydney a few weeks ago and we did 9 forums. So by the 9th, I had it nailed, but I haven't done one for a while. So I'm rusty. Okay, workflow. So this is what we do in workflow. Workflow, it's not rocket science. We work out where the flow of the dispute goes. So fast track will be single issue claim value less than $15,000. At this stage, that's the limit. We've increased it from 10 to 15. So for AFCA, whether or not we increase it over time to a little bit higher, I think what we need to have an understanding is get some more disputes data under the new AFCA rules and work out with complaints what volumes are doing, where they seem to be streaming, and what we think the sort of really good balance of a limit for fast track is going to be. Financial difficulty is where there's no dispute about liability, so it's purely, yes, I understand that I've got this credit that I have to repay, but I just can't because I'm ill, I've lost my job. So no liability issues there. Alternatively, rules where complaint needs a jurisdictional review. Initially, some of them may well be some where we're looking at whether or not it's previously been dealt with by a predecessor scheme. A reminder, we don't necessarily just take everyone's word for it. We need primary documents to demonstrate that there's previously been an outcome, either by way of a settlement or by way of a previous decision from a predecessor scheme, and we need those primary documents to demonstrate that. But we'll also have a close look to check, because often sometimes we get people that come in and say, no, we've already looked at that, we've already dealt with it. But if you actually look at what the complainant is saying now, it's slightly different, and it's further issues that have arisen since the original decision. So they're not things that we would exclude as previously dealt with. We would look at those new issues. So you need to look at those carefully to work out, is it actually the same issues that were dealt with that outcome? And then through into the standard and complex teams. So complex, larger claims, normally secured responsible lending, multiple issues, small business will go through the complex stream generally. Standard is sort of the dispute that fits in the middle, which doesn't really meet fast track and isn't definitely complex. So there's a reviewing jurisdiction chart here, which is actually replicated from the operational guidelines, and I do not even begin to imagine that you can see that the bottom one says file closed, let alone all the middle ones. So I'm going to leave that with you, but you can go on the webcast, have a look. But it is pulled directly from our operational guidelines, so go and have a look. That just gives you the ins and outs of all the different stages. When someone disputes jurisdiction, we exclude it, they come back and disagree. You might disagree, and then we go through a process there, which is all set out in detail in our operational guidelines. Case management. So case management is the stage where you will have active engagement from our staff, because we understand that the dispute's been through your IDR area, that you've not been able to resolve it. So our role is to now investigate the issues raised. So we often get questions about this, because people say, oh, can you put it on hold while we try and keep negotiating, because we think that we've nearly got an outcome there and we don't really want to answer your initial letters to give all the relevant information because it's nearly sorted. So the answer you will get from our staff is no, we're going to commence the resolution, the investigation process. The reason we do that is it's a bit like when you've got kids in the car and they're saying, are we there yet? Are we there yet? And we're not there yet. Because often what we have is, if we put things on hold to try and get a resolution, months go by and you've got no outcome. And what we're in the business of doing is giving timely outcomes to people who are in really difficult circumstances that need to get on with their lives. We take the IDR period very seriously. If you haven't resolved it in that stage, we will continue to progress the dispute and deal with the merits of the dispute. It's still open to you to continue negotiation, but give us all your information, answer our questions, attend conciliations, make sure you provide information, because we will be progressing the dispute whether we get that information or not. What we do ask you to look at is things with fresh eyes from IDR. That's one of the key things. If it can't be resolved through a conciliation or through a facilitated negotiation, then what we'll do is provide a preliminary assessment on the merits of the dispute. Now, depending on which stream that you go through, as in whether it's fast-track, financial difficulty, standard or complex, that the method of delivery of that preliminary assessment will be a little bit different. So fast-track, where Rachel and Neva are heavily involved, that will generally be over the phone. Sometimes in a very short 1 or 2 page letter, but generally it's over the phone. If it's a more standard or complex matter, it'll be by way of a recommendation. So what we've got here, and again, Wes Pan did an Academy Award performance in the webcast, so you'll be able to see his detail over preliminary assessment. I'm not going to do that here, but it just shows you the different ways that you can have a preliminary assessment delivered, and also the table from the operational guidelines. Any party can object to that assessment. What I would expect, though, from members, and what AFCA would expect from members, if you don't agree with the preliminary assessment, we would expect that you would provide reasons with background information and supporting documentation to explain why you think we got the preliminary assessment wrong, if that's what your view is. It's surprising how sometimes members will just object with no further information, and I think that you need to be able to explain what we didn't take into account that you think we should have, or why you thought our reasoning was not correct. So it's not something that we would expect members to just come back and say, we disagree with it, we want a decision. And I'll say, you know, we have seen that happen. For consumers, it's a little bit different, because sometimes they don't 100% understand, but they just think the decision's not right. The majority of consumers, overwhelming majority of consumers, give us reasons why they think it's not right, but there are some where that's going to be really tricky given accessibility issues. So we will progress the dispute to decision. So it gets to a decision. So it either goes to an ombudsman with grey head and a beard at the end of our panel, two adjudicators who are sitting in between Philip and Anna, or a panel. So panels at the moment have been used more in the investments advice. They will probably be used in superannuation. Remains to be seen, Philip, about banking. But at the moment, ombudsman and adjudicators will be the deciders for banking matters. So they'll have a look at the complaint afresh. They'll look at whether they need any additional information, whether there are any expert reports needed, make sure everything's exchanged so that we meet all our requirements for procedural fairness. Everyone's had an opportunity to make submissions, and then a final decision will be issued. Target timeframes. I'll just let you have a look here. I know someone did ask a question about our timeframes and whether we're going to be held to our timeframes. So, yes, we aim to meet our timeframes, but with everything, this has a heading which says target. The reason it says target is we are not always in control of our timeframes. Reason being is sometimes we are waiting for people in the room here to give us information. Sometimes we are waiting from consumers to give us information. So, you know, we're happy to plough ahead and do a decision and get something finalised, but if we haven't got key documents, sometimes we would prefer to get those documents, otherwise it will lead us to draw an adverse inference, which may not be in your favour for non-provision of those documents. At the end of the day, I think if you bring yourself back to the statistics I talked about before, that 87% of disputes were resolved last year in 90 days, under 90 days, that means 13% have gone beyond that. If you have a look at fast track with target timeframes, generally you would expect, and we're currently meeting this at the moment with a couple of isolated outliers, 60 days to a decision from when it gets allocated to a caseworker. Standard and complex, 90 to 120 days to a decision is what your average time frame you would expect. Financial difficulty, roughly 90 days. But again, case by case, and if you've got someone with significant mental health issues who has an advocate or who has a family member assisting them, someone with language difficulties where we've got to get things translated, you know, there's a whole lot of reasons why sometimes things can fall outside that time frame. At the end of the day, that's one of the other reasons why we won't put things on hold while you want to try and negotiate an outcome, because we need to deliver and meet those timeframes for people. The other thing I think that you need to bear in mind is if we have conducted a telephone conciliation, sometimes matters don't resolve at conciliation, and we will have members say, oh, can you just hold it there for a bit because we're close, we're nearly there. We will move it on within 7 days if it's not resolved. So, and when I say if it's not resolved, if we don't have signed terms of settlement or something in agreement with the applicant or the complainant and yourselves, we will move it on. And because in our experience, 7 days is generally enough to get the matter sorted post a telephone conciliation. If it's not going to resolve in that time frame, then we'll go to a preliminary assessment. So, what can you expect from AFCA? You can expect an independent review of the issues and the merits of the complaint, experienced complaint resolution staff with industry knowledge, respectful engagement from our staff who'll listen to your queries and concerns. One of the key things, when our staff initially get a file and have it allocated to them, they ring you up and say, these are the issues that I'm looking at, this is the sort of information I need. If you get any requests for information and you don't understand why we're asking for that, our staff need to be able to explain to you why they need that information and how it's relevant to the issues in dispute. If they can't, feel free to talk to their manager. It's critically important that you have an understanding of why information is needed, but if we've asked for it, we also need you to provide it, but we need to be able to explain why it's relevant. So that's something that, you know, we do have conversations with our staff about. You should be getting telephone calls before they're asking for information, so you can have a discussion with that. And you should be able to expect that if we think there's a jurisdictional issue, that we'll be referring it to our rules team as soon as we identify it. So that's part of the reasoning of where I showed you that original linear process, which had registration, then rules, workflow, then rules. So rules is not something that we do at the beginning of the process and never look at again. Rules is something that everybody who's dealing with a file, every time we get submissions, every time we look at information, we consider. So at any stage of our process, we can refer the matter to the rules team to have the matter considered, whether or not we think something's come in that might change whether or not we've got jurisdiction to consider the complaint further. You should be able to expect targeted requests for information, so not a lot of backwards and forwards with dribs and drabs of information. So you should be getting targeted requests with a whole lot of information up front. And you should be able to see a flexible and adaptable model in terms of getting the matter resolved. It's not one size fits all, because there is no one complaint that has this identical fact scenario. Every single complaint differs, and we need to make sure that we're flexible and adaptable to deal with that as well. What do we need from you? We need active engagement with the AFCA process. At the end of the day, you've got a customer that's not happy. Whether they're an existing customer or a previous customer, they were your customer or are your customer. Whether it falls within our rules or not, they're still unhappy. And that's a customer that you need to be having conversations with. So what we expect from you is active engagement with us. Participate in conciliations. I can't tell you how many times I've heard, and Anna Mandoki will be nodding here, I'm sure, because as Senior Manager previously for the Financial Difficulty Team, a lot of times when we're rolling out, and she's also managed the conciliation team, she's currently managing our Sydney office, we'll hear members saying, there's no way I'm coming to a conciliation because I'm not going to put anything on the table. There's no way we're going to make an offer on this. We haven't done anything wrong. You will be surprised at how powerful an apology is. And you will also be surprised at how powerful it is to just acknowledge that maybe you could have handled something better, even if you didn't do anything wrong. Sometimes that's what people need to be able to move on. Also, for quite complex disputes where you think there's no way it's going to resolve, what it can be a really useful tool is to actually define the issues so that the focus of the future investigation doesn't have all the extraneous emotional baggage, and you can actually just focus on the couple of key issues that need the outcome. So it's really an important strategy from that perspective. What we do need, though, from you also is open and honest communication. If we've asked for all relevant information and documents, or we've asked for specific documents as well, we actually don't know what you have. You know what you have, you know what is relevant, and what we expect is for you to provide us those documents, whether or not they're in your favour or not. It's been very interesting over recent months listening to some of the hearings at the Royal Commission, and what we expect is that documents that you have are provided to us that are clearly relevant to the dispute. We also ask that if you've got issues about jurisdictional concerns, to raise them early on. Don't leave it late. Don't give us the information late in the process. If it is something that we can't really consider because it's been looked at previously, we need to know. So all your business units that feed you up information, you need to know if they've had a settlement or there's any other aspect of the matter that we should know about. And I think the other thing is we need you to meet your membership obligations and your contractual obligations. So that means if there's a settlement, you need to meet it. If there's a decision, you need to implement it. And if there's requests for information, you also need to provide them to us. Managing complaints lodged with predecessor schemes, and this slide is almost theoretical now because 1 November is nearly upon us. What we will be doing is there are transitional timeframes in the new rules. Some disputes that are received next week that can't be referred across to the superannuation complaints body in time might be held. Our web online dispute form is coming offline at 12 o'clock on the 31st of October, so people won't be able to lodge disputes online from that time onwards. It gives us an hour to clear. We'll be madly processing everything in our system, so everything we've received will be under those old rules. If we get urgent, we'll have a sign on our website, because if there's court or recovery action on foot, we'll be taking those on the phone. So we still may lodge some after that time if they've come via the phone, but otherwise our online dispute form will go off at midday on that day to give us enough time to do the transition work for the new online complaint form that will be available 12:01 a.m. on the 1st of November. But again, I think I've covered off that we need your documents to show us about that. So just briefly, a couple of other things, systemic issues and other reporting requirements. So I'm sure everybody's been doing a lot of nighttime reading on RG 267, talks about serious contravention. So the term serious misconduct's no longer from 1 November. We've got power to report matters not just to ASIC but also to APRA and the ATO. We've actually been in discussions with ASIC, APRA and the ATO about the sort of matters that APRA would consider reportable to them, which wouldn't necessarily be reportable to ASIC. That's an ongoing conversation with us. I think the key thing for you to look at in this one is the third bullet point about settled complaints. So what we've got an obligation to report about is where we think settled complaints are unreasonably wide. The scope goes beyond what was considered in the dispute complaint. Non-compliance. Some of those may be considered what's called a serious contravention, and AFCA under the new RG 267 has an obligation to report what may be a serious contravention within 15 days of when we have identified that it may be a serious contravention. That's quite a shift. I think the one thing that people need to note is that if you have a decision or a recommendation which is binding or terms of settlement and it hasn't been complied with, we often would not report any of that as serious misconduct or refer it to our systemic issues team, because we would deal with it in the first instance as a stakeholder engagement piece. We now have 15 days to report that if it may be an issue. So that's not going to allow us that time, or you to have time to get things sorted. So what we'll be doing is we'll be contacting you as a member engagement piece, but we'll also be talking to our systemic issues team if there's been non-compliance, and there will be a two-way discussion. But you are going to have to get your skates on if you haven't complied with things when we contact you. And that's probably quite a significant shift, probably for most of you. There is a new e-learning module which goes through a lot of this all in more detail, which is on our website and also on the members portal. So I'm going to get to that now. Am I over? 5? Yep, I've only got 5 left. Perfect. Secure Services Portal. So the e-learning module, you can see it there, and it's something that's really handy for your staff with teaching e-learning. Complaints management function of Secure Services. This is where you can see all your dispute data. For anybody who's listening online, if you've not previously been an AFCA member and don't have the any complaints with AFCA at the moment, you won't be able to see the complaints management function yet. That will come online when you start getting disputes from 1 November, but you can all log into your member admin functions and member resources. And in terms of member resources, this snappy little chart, you can find that on the website as well, on the Secure Services page. You can find AFCA approach documents, EDR response guides, which Rachel's going to run through in another session shortly, fact sheets, the complaint fee guide, AFCA contacts and upcoming events. So I think I've pretty much gone through practical tips, but I think the main thing is if you've got questions, pick up the phone, talk to your caseworker. We're all on the same page with trying to get matters resolved. Consumers want outcomes in a timely and efficient way, and we're there to be fair and independent in delivering those outcomes. As I said earlier, it doesn't mean we're always going to agree on those outcomes, but procedural fairness, being open, transparent, and making sure we're focused on solutions is key. I think that's pretty much it from me. So unless there are any particular questions, I will hand over. Thanks.
Thank you very much, Di. Now, we've had a few online questions about where do you get this wonderful form from. As Di said, it is on the website, but it's also in the resources tab on today's presentation. So you can click on that, download it and print it out in colour or black and white, depending on your printer settings, but you probably won't get it on cardboard, but unless, of course, you have cardboard. Look, I'm very delighted to welcome up to the microphone now Sally Davis, the General Manager for Codes. Sally manages our code teams not only in banking, but also the customer-owned banking, general insurance, insurance broking, and life insurance. So she's got quite a code coverage, and she's going to talk to us about code. So welcome, Sally. That wasn't me, by the way. I'll be dropping my glasses later. So thanks, Sally.
Thanks, Philip. Okay, and I just want to kind of lift you up and away from the operational issues that you've just heard about from Di, and before I hand over to the other members of the panel, who I'm sure will be talking about those operational issues further, and kind of maybe lift you up more into the holistic space of good conduct, and share with you some of the issues that arise from the work that we do in supporting code committees, and in particular the Banking Code Compliance Committee. I couldn't be here for the beginning of the presentation, unfortunately, but I understand that Philip and Di both referenced the new AFCA strategy, and I think it's just a good place to start to understand the role of AFCA in supporting code committees, because AFCA has given a commitment in the new strategy to proactively work with consumers, small business and the financial services sector to resolve and reduce financial disputes. So it's really that reduction that's the interesting part. And priority will be to influence reform in the sector by raising standards and improving internal practices to avoid and resolve disputes. So to that end today, I wanted to share with you some of the information that has been compiled from the work that we do in monitoring banks' compliance with the Code of Banking Practice and the work we've just done. And in fact, I've just come from an on-site visit with one of the code subscribing banks, and I'll be going straight to another one after this, and we feed that information directly back into your organisations. So today you're get a chance just to see a bit of that firsthand and maybe some of the issues that might affect you directly. I'll also touch on and introduce the new Banking Code of Practice and talk a little bit about code transition and guidance in that space. So here are some of the numbers, and I understand you all have access to these slides, so I'm not going to speak to every number on the slide, but you will see from that each year when we run our annual compliance statements, there's a questionnaire that's sent out to all banks that subscribe to the current Code of Banking Practice, and that will be mandatory, as I'm sure you're all aware, has been announced by the ABA starting from 1 July 2019 in the new code. And we developed this questionnaire in collaboration with the banks to help them effectively self-assess their compliance with the code. I probably should take one step back. I meant to basically introduce the committee, which is an independent committee that sits apart from AFCA, but AFCA does provide the Secretariat support to that committee. And that's why I can share these numbers with you today. So banks reported over 10,000 code breaches in 2017-18, and they told us that over 3.8 million customers were impacted by breaches of the code, and that the financial impact was approximately 127 million. The banks reported that the main cause of these breaches was human error. Human error is actually always something that gets under my skin a little bit, because I think processes and procedures embedded in the bank should really be designed to ensure that human error doesn't occur. But in any event, will be a conversation we'll be having with those entities. So this is just a little bit of history of bank code compliance over the last 5 or so years. So you saw in the previous slide that over 10,000 reported breaches in 2017-18. That was a 9% decrease from last year. It's the only time there's been a decline in code breaches seen in the last 5 years. And really that's largely due to the quality of the reporting. We're probably approaching a more normalised approach now. But we do continue to question whether that's a true reflection of compliance. And I think with the new Code of Banking Practice, there are more heightened abilities to collect data, and I think there will be even more improvements in the data collection space and more detailed monitoring, particularly, of course, in the wake of the Royal Commission as well, and the role of self-regulatory codes and of committees that monitor those codes. Here's an example of some of the top breach categories by impact. Based on the sampling criteria, banks provided further details of the 10,132 breaches that were reported in 17-18. And you can see there the top code breach categories by financial impact and by customer impact. They're clearly that general obligation of supporting key commitments to the code, which is kind of an interesting section of the code, the current code anyway, and compliance with laws, because those sections are not directly able to be monitored by the committee. They're essentially carved out unless there's a specific breach, but that won't be the case in the new Code of Practice. So hopefully we will see more and more granularity in this information that we receive from the code subscribing banks. Here's also some further information, breach impact by bank. So you can see highlighted there the information provided by the Big Four. One of the reasons why we do that is that often the assumption is made that literally the first four in the list are the big four, and that's not always the case. So as you can see, the largest number of breaches, financial impact and customer impact largely, but not exclusively, came from the big four largest banks in Australia. One bank actually accounts for over 65% of these detailed breaches. One Big Four bank reported a $103 million financial impact, and this was due to two particular breaches and related to breaches of the key commitments clause. So banks' accuracy is something that we continually question year on year in reporting to the committee, and we can only draw the level of inference that is accurate dependent on the information that is provided. So on a more kind of a level probably that is directed to this audience, I thought I would pull out some of the information around the breaches that were identified in relation to internal dispute resolution. That's clause 37 of the 2013 code. So banks told us that there were over 1.1 million complaints resolved by banks, and that's code subscribing banks obviously, that covers off 95% of the retail banking sector in 2017-18, a 6.3% decrease from 16-17. So even though those overall figures are down a bit, 9 banks reported an increase to the total number of complaints. 4 saw a decrease, and there was 1 new subscriber during the 17-18 year as well. Again, 1 bank accounted for 67.5% of all complaints, and interestingly, the number of complaints reported by that bank actually dropped by 13% from the previously. So therefore, the differential largely accounts for the overall decrease. Banks report that they report on breaches in a number of ways. 11 out of the 14 banks reported that they record all expressions of dissatisfaction. Sometimes this is captured as a complaint, other times it's captured as a feedback or a suggestion. 1 bank reported that while it is their policy to report all complaints or expressions of dissatisfaction, there are problems with staff members applying that definition. In the view of the Code Compliance Committee, to ensure compliance with both the code and regulatory obligations, banks should be capturing, obviously, all expressions of dissatisfaction, and really should be encouraged continually to use this information to track trends and improve outcomes for customers. It should also be used to identify breaches at an industry level. At approximately 24% of code breaches are actually identified in this way. So I think it illustrates that the solution to improvement is to first identify the problem, and mining complaints data is one of the best ways of doing that. And I think that feeds back into the AFCA strategy to not only resolve complaints but reduce them as well. This is just a little bit more granular information about complaint resolution timeframes that I think is interesting in this forum. This chart includes industry and average figures as well, you'll see there. But 91% of complaints are resolved under 5 days in the industry as a whole. And the industry figures calculated using the total number of complaints reported to the committee by all 14 code subscribing banks. 77% of complaints are resolved under 5 days by individual bank average. The average figure is the mean average of each individual bank's percentage for each resolution time period. So it doesn't account for the bank's relative market share. There are pleasing trends in complaints being closed quickly or within 5 days, but we do caution the reading of these statistics through the fact that this needs to be read in terms of whether it's captured all the customer's complete satisfaction. In this graph, banks in both 16-17 and 17-18 saw the number of complaints vary considerably in April, May and June. I thought this was quite an interesting trend to call out, and it's good to be mindful of issues which affect complaints handling at these times. And actually, I'd be interested to know from EDR whether there are periods in which you see spikes as well. Here's some more information more on a product basis. So credit cards, transaction accounts and complaints not related to a product continue to be the top areas of concern when consumers make a complaint. And these issues have remained constant for the last 3 years. In 17-18, a significant majority of all complaints to banks concerned 3 main areas. Complaints about customer service or bank staff sitting at 23% this year, rates, fees, charges and pricing 22%, and product issues 21%. I think it is concerning to see that for a number of years customer service has been one of the largest causes for complaint. Again, that's the interest in this data, being able to mine it and use it to improve practice. So here's just a snapshot of some of the issues to watch out for and that we've seen over time. You'll notice that consistently the kind of 5 issues that are listed there year on year are pretty much identical, but they shift in terms of order. And again, like I say, I think complaints is an amazing source of data and an opportunity to review processes and experiences for improved practice. So, now that we've talked all about the 2013 code, I actually think it's important to just remember that that code hasn't been completely chucked yet. Banks are going to have to monitor and comply to that code until 30 June of next year. And a similar exercise to the one I've just illustrated to you now will be conducted all over again at this time next year, mapping to the current code with which you should be complying. But of course, you now have a new banking code of practice and new on a lot of levels. First time that it, or in fact any other industry code of practice, has been approved by ASIC under Regulatory Guide 183. It will be effective 1 July 2019, but we do understand that there is a possibility that there will be some early adopters of that code early next year, possibly, and so we'll obviously be monitoring to that. And there are implications for the Code Committee too that we support because, I mean, the first thing is they're going to have a name change. They're going to be known as the Banking Code Compliance Committee as opposed, so it'll now be BCCC rather than CCMC. But the really important thing is that they're being given stronger powers both in the body of the code and also in the body of the charter that will accompany that code. So I just thought I would give you a list of maybe the top 10 changes because it's a pretty long code. I'm not sure exactly, it's 50 something pages. I forgot to look before I came up here. But it goes to pretty granular detail about your obligations to the customer. So here are a few top 10 changes. Guiding principles are a statement that are made towards the front of the code and are said to underpin it. And they relate to 4 major areas: trust and confidence, integrity, service, and transparency and accountability. And be assured that the Code Compliance Committee will be monitoring all aspects of the code whilst remembering these principles that underpin it. So the fact that they seem to sit slightly apart from the code provisions will have no consequence to them. They will be applying these principles in doing their monitoring work. The second is probably the most contentious issue. If no one knew it before, they certainly knew it after the Royal Commission hearings, but the new definition of small business. So the current code, the 2013 code, actually always has covered small business, but there are changes to that definition, from one based on the size of the entity to one that incorporates financial thresholds, and it encompasses issues like, and it's actually quite complicated, an annual turnover of less than 10 million in the previous financial year, fewer than 100 full-time equivalent employees, and less than $3 million total debt to all credit providers. But again, I think that's a bit of a watch this space definition in light of some of the recommendations that were made by Commissioner Hayne. The third one there is stronger protections for small business. So not only a change in the definition, but there's now a dedicated section in this code in relation to small business lending, and it incorporates guidance on plain English documentation, loan decisions, non-monetary defaults, and enforcement proceedings. So whereas, as I said, there are protections in the 2013 code, this code certainly draws that out and highlights it. In fact, there's even a provision for this current committee to bring a fourth member into the committee, even on an ad hoc basis, to advise about small business issues as well. The fifth one, stronger protection also for guarantors. So enhancement of the protections for guarantors by creating an obligation on banks to not accept a guarantee from a customer until the third day after they have been given the information, as opposed to the current provision, which is, as opposed to the current one, which is the next day. Greater transparency about lenders' mortgage insurance, stating that if a bank requires a consumer to obtain LMI, it will provide a fact sheet and not charge more than the actual cost incurred for that policy. Take extra care with customers who are vulnerable. There is a new section of this code which is quite expansive and has expansive obligations for a broad range of vulnerable customers, including those experiencing age-related impairment, cognitive impairment, elder abuse, family or domestic violence, financial abuse, mental illness and serious illness. It does also reference the ABA's guidelines around these protections as well. Restrictions on the sale of add-on insurance. This is a really interesting topic for me because, as Philip mentioned, I'm kind of talking to you now wearing my hat as CEO of the Banking Code Compliance Committee, but I also do support a number of other codes of practice in the financial services industry, and this is an issue that definitely arises in relation to dealing with customers through the customer-owned banking sector, through the life insurance sector and through the general insurance sector. So there's a real theme around add-on insurance. But now this code will prohibit the sale of add-on insurance such as consumer credit insurance without the express consent of consumers to acquire it and the provision of supporting information for consumers. So much further than anything that's in the current code. Guidance and assistance for deceased estates, so there's more information on deceased estates, such as the information banks will provide to the deceased representatives. And the last one there is just greater inclusivity and accessibility for all customers. So there is a current provision around that in the 2013 code, but this again expands the commitment to older persons, persons with disabilities, Indigenous Australians and those in remote communities. So, like I said, the CCMC will be replaced by the Banking Code Compliance Committee, which will be known as the BCCC, a stronger monitoring body that will have the ability, aided by more regular data retrieval. At the moment, the CCMC only retrieves data every 12 months, but there is the ability under the new code to do that more often, and we will be doing that at least every 6 months. Investigate non-compliance more robustly and recommend improved practice, encouraging banks to achieve industry best practice. It'll be able to make decisions about compliance and determine breaches of the code, impose sanctions which include formal warnings, require training programs on the code, or requiring a bank to take corrective actions. Some of the sanctions that currently exist, of course, still exist. A bank can be named and shamed if they don't comply with monitoring that has been suggested by the committee, and a certain number of thresholds are met. And in fact, this new code also includes a provision for referral to ASIC. So just in terms of transition, I haven't got too much to say about that, unfortunately, because as, what did you call it before, Di? But referencing, we're still working through that, those kinds of issues. But at least now we have a timeline. We know that this new code will be in existence as of 1 July next year. So the CCMC will be issuing guidance to banks as it works towards transition, and it'll also be undertaking significant monitoring activity to assess compliance with the current 2013 code and to map to the new code. So that's all from me today. Are there any questions about this part of the work we do? Great. I'll hand back to Philip.
Sally, I've got a question.
Oh, God, the Ombudsman always have questions. John Price did this to me the other day too.
So I couldn't get that microphone to work, so that's why I came over.
Okay.
There are no questions online for you, Sally, but for debt buyers who buy bank debts, clearly the code is part of the contract, and so
That's
a lot
right.
of these obligations continue as part of the contract. How does the
right.
monitoring obligation, does that continue as well? Have you given any thought to buyers of bank debt, and do they
Yep.
have reporting obligations?
Yep, they certainly do. And I think the best way, and I hope that the committee will be in a position early in the period to provide some more guidance on that, but essentially it will be viewed that a code-subscribing bank doesn't divest itself of those obligations once it sells the debt, but effectively that those obligations move with the debt to the entity that's handling the collection of it. And I think you've actually brought up another really good, made me remember another good issue, I think, to raise, Philip, around the approach of AFCA towards, and maybe you even want to speak to that, but the approach of AFCA towards those banks that don't subscribe to the current code of practice. I mean, we will be in a new situation as of 1 July next year where there'll be more mandated compliance if they're a member of the ABA, but you may want to speak also to your approach in terms of banks that are not necessarily subscribers to the code.
Thanks for that.
Did you want to do that?
As I did say earlier.
Oh, did you? Sorry,
that,
I wasn't here.
Yeah, well, certainly in relation to the small business definition, but the code does represent good industry practice, and we have said to non-subscribing banks at the moment that
Yeah.
effectively they will be applying those standards anyway. So,
Good.
and there are lots of other codes as well. So, and COBA, the Customer Owned Banking Association,
Yep.
is commencing a review of their code as well. So I have enjoyed watching over the years how the banks come out with a code, and then COBA leapfrog, and then the banks leapfrog again, and so that little bit of competitive pressure there to improve standards has always been fun to watch.
Except, to be fair, everybody's reviewing their code at the moment.
True, yeah, that's true. I wonder why. Is there something going on?
Yeah.
Haven't noticed.
Thanks,
Thank you very much, Sally. That was great. And Sally, as she said, has got some meetings with some subscribing banks, so she's going to leave us. So last chance for questions. All done, all finished. Oh, a very short question. Just wait till we get a microphone to you because we do have an online audience. So sorry, Sal, I thought I'd let you go, but that's all right.
Was out here.
Yeah, to what extent, well, financial institutions generally use external auditors to audit their practices. And now, to what extent then, what are they doing if we have to get to a stage of a banking commission? How implicit are auditors in their failure to sort of notify a financial institution of poor practices, or banking institutions ignoring recommendations of external auditors with regards to their doing their business? You know?
Well, I suppose it'd depend who or what the auditor was mapping to is really the way I'd answer that. I mean, in a way, I think the work that the Code Compliance Committee and all the Code Compliance Committees that we support do is they're essentially conducting an external audit mapping to the code. And often what the difficulty is for the relevant financial institution is that actual mapping to code as opposed to necessarily mapping to regulation. And I think that's where we see the difficulties, and whether an auditor that's been put in place by an industry member is actually mapping to the code is a very good question. I mean, we don't know the answer to that, but we would suggest they probably should be. And, you know, often it's at these types of on-site visits, for example, it is the compliance and regulatory people that we're meeting with, so they're thinking about that every single day and the different lines of defence to ensure compliance with the code. But I think, to be fair, up until relatively recently, the focus has been on compliance with regulation, not necessarily mapped to the code. So we're actually quite happy there's a renewed focus on it now.
Thanks very much for your question. Thanks, Sally. And maybe that's a question you can add to your survey about the role of external auditors and what they're doing. Yep. So thanks again, Sally, and that was great. And now I would like to invite Rachel Ehrlich to the podium. Rachel is one of our adjudicators, and many of you will have dealt with her, and she's going to talk about our EDR approach guides. So response guides, is that what they're called? Approach response guides. So a wonderful new topic for Rachel, and hopefully for you as well. So thanks very much.
Hello. So I'm here to talk about the EDR response guides, which you should all have been able to grab a copy of from outside, and I encourage you, if you haven't already grabbed one, to grab one and share them around with your colleagues. We've prepared these guides to assist you, the financial firms, to prepare a quality EDR response. And we've currently got them prepared for complainant chargebacks, credit listings, financial difficulty, for merchant chargebacks and mortgagee sales. And watch this space for a guide on debt collection conduct shortly. Now, these guides are just a guide. So they won't necessarily cover off all aspects of a complaint, but they're a really good starting point to help you to prepare an EDR response if and when a complaint arises. Now, when you're responding to a complaint that you've received from one of your customers, you need to be able to address all of the issues that have been raised. So sometimes there might be a single issue, other times there'll be multiple issues. So it's really important to make sure that you cover off all the issues when you're completing your response. You might need to refer to multiple guides in preparing a response, or to an approach on our website if there's no guide ready as yet. This is your response, so you need to make sure that it's sent to both AFCA and to the complainant. And it's also important that it covers off and is beneficial to all parties. So you need to be able to explain to your customer the reason for the approach that you've adopted in addressing their complaint. And you also need to be able to explain to AFCA the reason for your positions. We may seek more information from you along the journey if the complaint progresses through our process, but it would be really assist us and also your customer if you were able to provide a fulsome response at the EDR stage and also to provide supporting documents up front. Now, the guides may change over time, so you might need to keep refreshing and looking back to see whether there has been a change to the guides over time. So why don't we take a look at the EDR response guides for a complainant chargeback in the first instance. So when we get a complaint about a complainant chargeback, what we're going to consider on the left-hand side of the slide is whether the chargeback was appropriately raised for the disputed transaction. So did you raise it for using the correct reason code under the scheme? And if you didn't raise a chargeback on behalf of the customer, you need to be able to show us that there was no chargeback right in existence at the time. So that's what we're going to be looking at in terms of looking to address the complaint. Now, what information would we like to see from you? We'd like to see the customer complaint form. So what information did the customer give to you when they raised their complaint or disputed the charge on their credit card? When did they provide it to you? So what was the date? What did they tell you? What information did they provide you to support their claim? We also will need to see any terms and conditions that are applicable. We're going to want to see the relevant sections of the scheme rules, so the relevant chargeback reason code that's been relied upon. We want to see correspondence that you've received from your customer. We also want to see a copy of the complete chargeback file. So that means we want to see the source documents to show the date, then the reason that you used to raise the chargeback, the information that you provided in support of the chargeback on behalf of the customer. We want to see what the response was to the chargeback from the merchant. We want to see what supporting document the merchant may have provided. We also want to see, did you then go back to your customer with that merchant response and request further information? If so, what did you request? What did you receive? Did you then pass that along and take it to pre-arbitration? What was the response? So we need to see it each step of the way, and we need the source documents as well. And ideally, we want you to be able to tell us what document was used at what stage, rather than just providing a PDF of multiple documents without any context as to what was provided, when, how, who gave it to you. And if the dispute, if the chargeback went all the way through to arbitration, we want to see a copy of that arbitration decision. We also want to see what information did you provide to the arbitration committee in order for it to make its decision. We want to see correspondence that you've engaged with your customer. What did you tell them? How did you tell them? What date did you tell them? So these are the sorts of documents that we'd like to see, and we know that if the dispute progresses, if you're not going to resolve the dispute, then these are the sorts of documents we're going to need to see at the next stage. If you can provide them up front when you're providing your EDR response, then that would just assist us in moving the dispute through in a timely and efficient way. Credit listings. Most of these will come through to the fast track team, so I've probably dealt with a few of you on a credit listing dispute. We're still currently seeing disputes come in under the old regime, so listings made before that magic date of 12 March 2014, and seeing credit listings that were made after that date. So we're still looking at the two regimes, and there are slightly different processes depending on at what date the credit listing was made. So what do we need to see up front from you in terms of looking at a credit listing dispute? We'd like to see a copy of the privacy declaration or the consent that the customer signed at the time the account was opened. We're often seeing a reason raised that there was no declaration, there was no consent to reporting information onto the customer's credit file. We need to see the credit contract, so the source documents there. We need to see, I don't know if it's up there, but the account statements. We really need to see the account statements, and we'll need those for a period before the date of the listing as well. We need to see copies of all the notices that were sent to the customer, which clearly show us the address that that notice was sent to and the amounts claimed. We'll need to see details of the complainant's address history. Often a complainant will say that they didn't receive the notice because it wasn't sent to their last known address. So that's why we're often asking for address history records and dates that addresses were changed or updated and how those changes were, those instructions were provided. We need to see system notes as well as collection notes. Now, I know some financial firms keep them all together, some keep them separately, so we need to see them both. We need to see any other correspondence other than just the statutory notices that were sent. We need to understand whether or not there were discussions around financial hardship, financial difficulty, and what any arrangements that may have been entered into are. Which leads us nicely on to financial difficulty. So, where a dispute is brought around financial difficulty, we would like to see you provide a brief history of any previous financial difficulty assistance that's been provided. And it might be easier for you to do that in a table. Sometimes we find that tables are much easier for everyone to understand and to read through rather than lots of paragraphs of just a whole lot of written word. So there's just an example there of just how it might be easier for you to set it out both for AFCA as well as, more importantly, for your customer. And we would expect that you would provide us with the relevant supporting information. And we often, and we'll ask for a credit facilities table to be completed, which will set out what facilities the customer currently holds, the limits of those facilities, what the arrears are, etc. So those are really important for us to get an understanding of the position that the customer finds themselves in. We need to know details of any proposals that you have sent to your customer to try and resolve their financial hardship. We'll need to see the loan contracts, any guarantees, terms and conditions, account statements for a period before the date of the complaint. We'll need to see your contact records, collections notes, system notes to see when did your customer contact you, how did they contact you, what did they tell you. We might even ask for call recordings of conversations that you've had with your customer. We're going to want to see any of the demand or default notices that you've sent to the customer. That will often trigger them to contact you and ask for hardship assistance, because the Section 88 default notices will actually direct them that they're able to request hardship assistance. That might be the first time that a customer knows that that option is available to them to ask for. We want to see any correspondence that you've exchanged with your customer, or any those previous requests if there have been some. If you have assessed your customer for financial hardship, we want to know what documentation did you base that on, what did you ask for, what did you receive, in order to understand your decision. And if there are legal proceedings on foot, we need to understand at what stage in the process you got up to. Okay. And we've looked at complainant chargebacks, but sometimes we will see a dispute that's been lodged in relation to a merchant chargeback. So what will AFCA consider in this situation? We're going to look at whether or not you have debited that disputed transaction from the merchant facility appropriately, and have you responded appropriately to the chargeback requests that have been lodged. So that's what we're going to look at, and the information that we need in order to investigate that dispute is we will need to see the signed merchant agreement. Now, often there are terms and conditions, operating guides, and various other guides that go hand in hand and form that the full merchant agreement. We'll need to see all of those. So you need to be aware of what documents comprise the agreement and provide all of them. We'll need to see a signed merchant facility checklist if there is one. Did you provide the merchant with training especially in relation to moto transactions, so card not present transactions. What training did you provide them? When did you provide them with that training? We're going to need to see the account statements to see when those transactions were processed through the facility. We'd like to see the disputed transaction form that the cardholder completed. Now, you might not have the actual form, but you'll certainly have the chargeback file that sets out the reason for which the chargeback has been raised by the cardholder. So we need to see those source documents. We need to see any supporting documents that the customer or the cardholder sent through with their chargeback. So they might have, for example, sent through an invoice, or they may have sent through information to show that they cancelled an order before delivery. So we need to see all that information. And we need to see the relevant, again, the sections of the card scheme rules that the chargeback has been raised under. We need to see what correspondence there's been between the banks and between you and your customer. We're going to want to see all documents that have been received from both sides. So that really is when we ask for the full chargeback file, that's what we're asking for. And again, if this has gone to arbitration, we need to understand what documentation did you provide to the arbitration committee and what decision did they reach. And finally, mortgagee sales. Now, we have an approach document on our website, which I encourage you to go and have a look at, which provides further information about how we approach these disputes. But a financial firm has certain obligations when it is selling a property as mortgagee in possession. Firstly, you must make all reasonable care to obtain market value for the sale of that mortgaged property. You also need to have marketed the property appropriately and for an appropriate period of time, as well as generally a sale by public auction. And if it's not done by public auction, we need to understand why that's the case and why it was appropriate that you chose to sell by private treaty, for example. So we're going to look at, when resolving a complaint that relates to a mortgagee sale, have those obligations been met? Was the property sold for market value, and was it appropriately marketed? So you can probably imagine there's a lot of documentation that we'll need to support for the bank to provide to us so that we can understand what's taken place and whether those obligations have in fact been met. So what we would like to see in this instance, and preferably up front if you've got that information ready, any court orders, any valuations that were obtained or market appraisals that will sort of explain what that market value was predicted to be. The advertising schedule from the real estate agent, which sets out where the property was advertised, how often it was advertised, copies of those, any advertisements, so website advertisements or anything in the newspapers, local papers, we want to see copies of those. Marketing information that the agent has put together, so brochures that they handed out to prospective purchasers. We want to see marketing updates from the agent, so they'll often report in sometimes weekly as to the progress of the campaign. We want to know where any ads were published and the schedule. We want to see any reports on comments that were received from the interested party. So often if people turn up to an open for inspection, they might make a comment to the agent who'll record that. So we want to see all of those records as well. We want to know if any offers were made, what those offers were, what correspondence was sent to any potential purchasers that will be relevant, and any responses to genuine inquiries. We're going to want to see the auctioneer or agent's notes in relation to any bids that were made at that auction, and about any subsequent negotiations if it didn't sell under the hammer. And it continues because we need to see lots of information. We need to know if there was a decision not to go to auction but to sell by another means. We need to understand, well, why? And as well as what were those costs incurred in that process. So there's some listed there. We're going to want to see the documents recording the expenses incurred over the course of the sale process. the costs that were passed on to the complainant, and we want to confirm that the RITC, or the reduced input tax credit, was taken into account before those costs were passed on. So before I hand over to Neva, has anyone got any questions about what we've covered? I encourage you to take those response guides back with you to your office and share them around, so that people that are responding or providing their EDR response have got a guide or a reference point to assist them in providing that fulsome response and the relevant supporting documents. Thank you.
Hi, my name's Neva. I'm an adjudicator at FOS, soon to be AFCA, and I have the fantastic job of speaking to you today about e-fraud and financial scams. So this is a topic that I could happily speak to you for hours about. Luckily for you, I only have 20 minutes, so I'm hoping Philip will help me stick to that amount of time. So in these 20 minutes, what I will cover, I'll look at some trends involving e-scams and frauds, and then I'll go through what our approach is when we see these types of disputes, and I'll briefly touch on some specific sort of types of scams that we see frequently, and discuss what we look for and what we need and what some of the outcomes are. So turning to the trends that we see in relation to scams. So up on the screen, I've pinched a graph from ScamWatch, and that graph sets out the top 10 scams by the amount of money that's been lost to consumers. And so this graph was taken at the end of September, from memory. Sorry, no, the beginning of September. And if you can add up all the figures, which I don't expect you to be able to do, at that time, almost 80 million had been lost to consumers, and that's just the amount that's actually been reported to ScamWatch. I checked last night, and I think the figure's closer to 90 million now. So it's clearly a significant issue, and it impacts consumers and banks, and it's certainly an area that we see a lot of disputes in. So I think the areas where we investigate, and we've certainly seen an increase, it's quite consistent with what we see up on the screen. So we see a lot of disputes where investment scams have occurred. We've seen a really big increase, certainly in my view, in relation to the false billing or the fake invoice scams, which from discussions with some banks that Philip and I attended recently, I think that was consistent with some recent trends that the banks are also seeing, is these intercepted and amended invoices. We continue to see dating and romance scams, and we also see scams where an applicant has been the victim of remote access, and internally we often refer to that as a cyber shouldering dispute. So what we consider in disputes where scams are raised. So what we ask for really depends on the circumstances of the case, which I'm sure comes as no surprise. But the starting point for each investigation or a dispute that's lodged with us is, how did the disputed transaction that is the subject of the scam take place? Was it an online transaction? Was it by internet banking? Was it a mobile phone app? Was it a moto transaction or a cardless transaction? Or it may have been an in-branch, over-the-counter withdrawal. And the dot points that I've got up on the screen certainly aren't an exhaustive list of the questions that we'll ask, but each of the dot points up there, certainly I think it's safe to say, is a starting point, and it will form the basis of our investigation. So if the disputed transaction was an electronic transaction, the chances are that we'll look towards the e-payments code. If we're satisfied that it is a fraudulent transaction. It's likely it's an unauthorised transaction, so we'll determine liability in accordance with the liability provisions under the e-payments code. It may also be appropriate, if we're satisfied that it was a mistaken internet payment, to consider the MIP regime that's set out in the code. If it was a credit card transaction and a transaction wholly done online without any card being present, we'll consider whether or not the bank has met its chargeback obligations. If the transaction was done in branch, it may be appropriate for us to consider the FOS approach to elder financial abuse, and I'll go into that in a bit more detail further on. What I cannot stress enough is that each dispute is unique and it's decided on a case-by-case basis. Sometimes, and particularly in the standard and complex spaces, these investigations can be really complex. They can involve trawling through pages and pages of transaction logs and statements, and they can take quite a bit of time. But there certainly are scenarios in which we've found a bank liable for transactions that are the result of a scam, and there certainly are scenarios where we will require a bank to reimburse its customer for those transactions. So if you recall from the first slide I had, the most amount of money that had been lost to scams was in relation to investment scams. And so I'm sure it comes as no surprise to everybody here that this is an area where we've seen a significant number of disputes in relation to. And I think the most common type of investment scams that we see is in relation to the binary options trading. And with these types of investments, consumers are basically betting on the outcome of an event. And this is generally the movements of commodity or index prices over the short term. These investments are speculative and they're generally high risk. So scammers will frequently cold call consumers and encourage them to invest in these binary options trading with the promise of making a lot of money very quickly. And usually with the assistance of the scammer, the consumer will open an online trading account, and the scammer will then walk the consumer through the first few trades, and it will come as no surprise that those first few are successful and the consumer will receive large returns. And at the same time, the scammers encourage the consumers to increase their investments. And when the consumers do invest large sums of money, their money will very quickly begin to disappear. So when these disputes are lodged with us, generally the transactions are authorised by the consumer, so the e-payments code doesn't apply, and there's also generally no chargeback rights. And while we do accept that banks don't have a duty to actively monitor their customers' accounts, there are some circumstances where we will find in a consumer's favour, and that's particularly when we've become aware that ASIC have sent emails to banks warning them that certain merchants and certain companies are fraudulent and directing them to stop and try and prevent those transactions, but the banks haven't taken that action. In those types of scenarios, we do generally reduce some of the compensation payable to the applicants or complainants, and this is to take into account their own actions in failing to take reasonable steps to protect their own interests. But what we expect from financial firms when we see these disputes is any information that they may have received from ASIC, directing them to try and stop these transactions, and then what steps the financial firms have taken to try and implement ASIC's directives. So I won't spend too long speaking about romance scams because sadly it's not something new. I think romance scams have been around for a long time and they continue to result in people losing thousands of dollars. So when money is lost to romance scams, the e-payments code doesn't apply. Generally the transactions are authorised. Likewise, there's no chargeback rights. But what we would expect is for a financial firm to take reasonable steps and to make reasonable endeavours to try and retrieve the funds from the recipient account. But we do understand that the object of these scammers is to obtain as much money as possible as quickly as possible. So we often find that the recipient accounts are quickly emptied. There are, however, some scenarios where we have found a consumer who's been the victim of a romance scam, and we found in their favour. And this may be, and I think it generally is, when the consumers conducted the transaction in branch. And in these scenarios, we'll consider our approach to financial elder abuse and whether or not there were any red flags that the financial firms ought to have been on notice of. And I'll go into this in a bit more detail in a few slides. So this is remote access scams or cyber shouldering. And with these types of scams, the complainant allows a third-party fraudster to remotely access their computer or their mobile phone or their tablet. We've seen complainants being told by scammers that they're calling from Telstra and Optus, their bank, another bank, the Federal Police, the Australian Tax Office, Microsoft. So we, like I'm sure you guys have seen, is all sorts of different variations. Some consumers may not even be aware that they're being cyber shouldered. I think we can all agree that with all the different advancements in technology, that sometimes these scammers are 2 steps ahead, and they really do know how to work their way around the system. If we are satisfied that a scam has been committed and the disputed transactions have been the result of somebody being cyber shouldered, we will generally say that the transactions are unauthorised, and then we'll turn to the e-payments code and consider who should be liable under the liability provisions of the code. The code is quite convoluted and long. What's important at this point is to say that an applicant generally isn't liable for any unauthorised transactions where they have not contributed to the loss. In some instances, we will find an applicant liable for their loss if we're satisfied that they've breached their passcode security requirements, and they can do this by disclosing their internet banking password or the SMS codes over the phone. If an applicant is unaware that they're disclosing their passwords to these scammers, and often if there's some keystroke logger that's been installed in the background, they might think that they're just entering the code and it's not visible to anybody, we may say that they haven't voluntarily disclosed their code. With these types of disputes, the financial firm's transaction logs are key. We need to see each occasion that the account's been accessed online, that the account's been accessed via a mobile phone app. We want to see the IP addresses that have been used to access these accounts. Helpfully, I had a case where the financial firm was able to drill down into the detail and provide me with the different type of mobile phones and the IME numbers, I think they're called, of the mobile phones. And in that scenario, that became really determinative in our final decision. And it's also really important that the financial firms obtain a really full and detailed description from the consumer at the time that they initially raised the dispute or the complaint with the bank. And it's often, right at the beginning when they've raised this, that we'll get a wholesome and a realistic explanation of what's happened, rather than a version that might change later down the track to try and fit into an outcome that's in the consumer's favour. So at this point, I think it's important for me to sort of speak about our approach to elder abuse and undue influence. I won't go through all the points up on the board, but the reason why I think it's important to raise this whilst speaking about scams is because all the data from ScamWatch and certainly in our experience shows that those who do fall victim to scams, while not in all cases, they're generally elderly, they're more vulnerable, they might not be as technologically advanced as a lot of us who have been used to conducting our banking online for many years now. And why this is relevant is because I think elder abuse can often go hand in hand with scams, and it can become apparent particularly when an elderly customer presents in branch and out of the blue asks to transfer $50,000 to a long-lost relative in an overseas country commonly associated with scams. And so what I think it's important to bear in mind is that we published a really fantastic approach, I think last year, in relation to financial elder abuse, which is available online. So I'd encourage you all to go and read that approach and just bear that in mind. There are, on the screen, I've listed some of the behaviours that may signal elder abuse. And this is obviously relevant if there's a face-to-face interaction with the customer in branch. It may be that the customers, they may exhibit signs of fear or anxiety or stress. They might be reluctant or confused about what they're doing. Often the scammers coach and talk through the customers. So when they go in branch to conduct the transaction, their mobile phone is, or the call to the scammer is still occurring. If they give an implausible explanation about what the money or the transaction is for. So there's a few other behaviours that might signal elder abuse. And what financial firms should do in these circumstances may include talking to the customer, perhaps raising the possibility that they've been caught up in a scam with the customer. If it's a joint account, maybe delaying the transaction and trying to speak to the joint account holder. Importantly, the branch staff should be making detailed file notes of any conversations that they have, and it may even be that the bank decides to block or delay the transaction. So we certainly recognise that these aren't easy conversations to have with customers, but given the vulnerability of these customers, we certainly expect there to be something more than just processing these large unusual transactions overseas. And the final topic that I think's worthwhile speaking about is these false billing and fake invoice scams. And this is definitely an area where I've seen a drastic increase. I've been at FOS for over 7 years now, and I think when I first started in the transactions team, these types of disputes were unheard of. And as I mentioned, I think from discussions with some banks, they've also seen a marked increase in these types of disputes. So with these disputes, the third-party fraudster somehow intercepts or generates an invoice, and they alter the bank account details of that invoice and then sends it over to the victim. And I don't know how these fraudsters know that this is happening, but the victim is expecting an invoice. We've seen a lot of them where they're the consumers are thinking that they're paying their builder, so they're expecting a large invoice from their builder. The explanation in the covering email is, we've updated our bank account details, please send your next $30,000 payment to this other account. And then the money quickly disappears. So with these disputes, the outcome really does depend on how the transfer was made. If the transfer was made online by internet banking, we generally see the outcome in the financial firm's favour. The bank has a duty to exercise a due care and skill of a diligent banker, and we also recognise that there's no general duty for a bank to monitor its customers' accounts. But once the bank is on notice and they are aware that there has been this false or fake invoice, we do expect a bank to be able to take or demonstrate that it's taken prompt steps to try and recall the funds. And unhelpfully, what's not up on the slide, but I'll make sure it's in the next presentation, is that with the online transfers, that generally there's a warning that comes up when the payment is made, and that warning should set out that the bank doesn't cross-reference account names with account numbers. So an outcome might be different, and we've certainly seen this, if a transfer was made in branch and the payment instructions given by the customer included the payee's name. So we've seen several disputes where the name of the account forms part of the payment instructions, and what's important in these scenarios is that there's no warning in these forms that the bank will not refer to the account name, when they're processing the transaction. So in those scenarios, we've found that the payment that the bank's processed has been a payment that's been made in breach of mandate, and we've required the bank to reimburse the funds back to its consumer. So that was all I had time for. Hopefully I've stuck to my 20 minutes. But what I think is really important is Scamwatch have a lot of information online about scams. I think it's really key that we educate customers and applicants that there are these scams that are being committed. I was horrified last week when I got a phone call from my mother-in-law who had almost been caught up with a scam. There is a publication from Scamwatch called The Little Black Book of Scams, which is available online. So I encourage you perhaps to have a read of it and refer customers to that publication if relevant. Thank you.
Thank you very much, Neva. And one of the things that we have been looking at recently is the adequacy of those warnings that are online. And we did a quick survey ourselves and saw that some were terrific and some not so. And we're having some discussions with some of the bank CDR people about improving that generally across the board. So watch that space, or you don't have to wait for us. You can go look at your warning and go look at the e-payments code to see what you actually need to do. All right, so do we have any questions? One, if you are having trouble downloading that wonderful little form, I'm told it is on the resources page, but if you're having trouble after the session today, Claire, our wonderful events coordinator, will arrange for the links to be emailed to everybody who's registered. Whether you want it or not, and you can download that form. So thank you very much, Claire. We have some questions online, but before I do that, is there anyone in the room with any questions whatsoever about AFCA? Please, not any questions whatsoever, because I know you want to hear about the prospects for the Sydney Swans in 2019, but that's not what we're here for. We can talk about that afterwards. Any questions? Yes, just wait for the microphone though, thanks.
Thank you. One thing that I find quite irritating, I know my colleagues do, we get a complaint where a customer has said that they've already been through the IDR process, they've already given us a date of complaint. We check our complaint history and no such complaint has been registered. It is a bit of a time waster for us as well as FOS at the moment and AFCA going forward. I was just wondering, is there going to be any changes to that rule for the applicants to actually have to substantiate their claim?
Can I maybe answer that?
Yeah, go for it.
We take information on face value from complainants. If you don't believe they've actually been through IDR and had the full 45 or whatever it is, if it's 21 for financial hardship, then you can contact the registration area and you can get the complaint moved from post-IDR referral status to IDR referral status, which will give you the 45 days. So that will remain the same, but it is a service that's free to consumers. They don't have to substantiate their complaint before they have to lodge their complaint, but if it hasn't been through IDR, you can get that switched across, but do it straight away as soon as it comes through the door. Yep.
Thank you.
And as I always say, go and have a look to make sure that your IDR is accessible and people can find it easily, so without too much trouble. So often it's hidden away down at the bottom of a website somewhere. So do make sure they're accessible. I've got we have a few pre-submitted questions. Oh no, we've got one here. Yes.
Yeah, just to follow up to that question, if you do receive it and you do follow through your IDR process, when you're reporting the statistics at the end of the financial year, do you actually include IDR complaints resolved in your statistics, or are they excluded?
Is this for IDR reporting for ASIC or what?
So the statistics you provided earlier of the complaints received by FOS, do they
Yep.
include IDR statistics, so the ones that are referred back under IDR and...
So they're the ones so the figure that I talked to you about, the 44% at registration referral, that comprises both IDR referrals and post-IDR referrals. So it's a combination of the two.
There's a one question limit.
This is my first one. Okay, so you mentioned before in regards to the warnings that we offer customers about not matching the names to the account.
Yes.
Now, is that considered sufficient or not?
Yeah, yours,
Yeah, but then I want to know what your ruling is.
Westpac.
St George, Westpac, yes. the
Oh,
same.
no, Westpac's was all right, St George's wasn't. Interesting, really.
Okay, well, we do both.
Yeah, you've got you've got different warnings, so,
Yeah?
yeah.
Okay, well, I'm asking you a question from Westpac then. If you're saying Westpac is sufficient,
Westpac's is not too bad, but as I said, we're going to have a discussion with, so we hold regular meetings with what's called the FSDRG. I don't know whether you've heard of that. Certainly the people that coordinate that and I have had some discussions, and we're going to bring that to that particular meeting to talk about the adequacy of the warnings and whether or not they comply with the e-payments code. The e-payments code is quite specific about what needs to be in the warning in order to ensure that you can process a transaction without matching the name and number.
yeah. Well, I mean, that is probably the major ring, because we're getting a lot of these issues recently. And then on the reverse side, as the receiving bank,
Yes.
we're also getting into trouble for accepting those funds where the names don't
Yeah.
match.
Good.
The
So
warning-
develop a system which you have called the new payments platform eventually, which matches name and number, and then you don't have these problems. But the issue has arisen because banks did not want to develop a system that matched name and number, yet was built on a system that actually asked for that, relying on the old check system of BSBs and account numbers. So the system itself is not, I mean, it works, but it's not a flash system. So until the new payments platform gets critical mass, these issues are going to continue. And as a receiving bank, you still have obligations to your customer to collect monies on their behalf. And these laws aren't new. They're not. There's nothing. We're talking about banking contracts and the legal interpretation of them that go back over 100 years. So these obligations are not new. It's just that you've got systems that don't match what your obligations are.
Yeah, the reason I'm asking, Phil, is because we've had so many cases recently where if we're the sending bank,
Yep.
and we approach the other institution, we can't get the money back, we then still have to credit our customer.
Yep. And
I know that you've said this in the past, it's up to us then to go to the receiving
Yes.
bank and try and get the money. That just never happens.
yeah, and that's another issue that's up for discussion at this meeting as well.
Yeah.
So certainly under the FOS terms of reference, the AFCA rules, we're unable to deal with the matter where to bring the receiving bank into that dispute because there's no financial service being provided. But one of the things we are having a discussion about and what banks are going to be asked to consider is whether or not they consent to being made a party to those proceedings in any event so that sending and receiving banks can be dealt with at the same time.
Yeah, well, probably 90% of the ones I'm talking about are they have consented. They've done this.
No,
done
to,
this
to,
themselves.
to b- consent to be part of our process so
Okay,
that we
so
can look at the
right,
whole
so
of the
it's
dispute, including the receiving bank and the sending bank, and work out who's liable so that you don't have to worry as a sending bank to get some form of indemnity from the
Yeah.
from the receiving bank, who may or may not have done the right thing. I will say, as I have said before in relation to these things, though, is that it is swings and roundabouts. Sometimes you'll be the sending bank, other times you'll be the receiving bank that hasn't done the right thing. So just bear in mind that you won't always be in that situation of the sending bank trying to get the money back. Sometimes the shoe will be on the other foot. So.
But we seem to be getting penalised in both ways then. So for argument's sake, another bank's customer comes to us and said, I sent money to your bank, went to the wrong person.
Yep.
And we're getting penalised that way as well.
Yep.
So it's like we're getting penalised on both sides and we don't know where to turn. Which way do we go?
Well, I'm not sympathetic to you. We can develop
Yeah.
a system that actually works, and you have, called the New Payments Platform, but no one's taking it up with critical mass yet. So that will probably be the answer that solves this. But while you still have the old system in place, you'll still continue to have these problems and have to deal with them.
Okay.
Sorry. Question online, so asked, does AFCA have avenues for appeals process if a member disagrees with a decision of AFCA? The answer is no, so except for superannuation disputes, which I'll talk about separately. So as with the predecessor schemes, a decision is binding on the financial services provider if the customer accepts it. That remains unchanged for everything other than superannuation disputes. You may be able to take legal action, but I'm not going to advise you how to do that. You can take your own legal advice if you choose to. If you believe that a matter is of significant legal or industry importance, there is a process in the AFCA rules, like there have been in the predecessor schemes, to take a test case. That provision has been used very, very sparingly. There is in fact only one that's actually gone to trial. It went to trial in August 2016 in the Federal Circuit Court, and as of last Friday, I haven't checked this week, we're still waiting for the decision. So we'll watch that with interest. So no, there isn't an appeal process now for superannuation disputes, because in the federal, under the SCT, the Federal Court has jurisdiction to review those decisions, and those provisions have been brought across. If you want to know more detail about that, Di, is there any place that...
There's information under the superannuation transitional guideline and the operational guidelines under the superannuation section. So there's quite a bit of information on our website and on the Secure Services portal.
Okay. Another question, would AFCA investigate complaints where an outcome was reached with a complainant as a result of an ASIC enforceable undertaking? Di, do you want to have a go at that one?
So if there's been an enforceable undertaking and there's been a remediation as a part of that enforceable undertaking, if a consumer comes to us prior to going through the remediation program, we will generally, if we know about the remediation program, A, and B, if you've told us that that consumer formed part of the scope of the remediation program, which we need you to tell us, we will refer them back to the financial firm that's doing that remediation. But generally, as part of a remediation, the option will generally be the terms that ASIC provide is at the end of the remediation, they have an option to go to EDR to check whether or not the financial firm has met their obligations under the remediation. That's a little bit of a bespoke process for post-remediation disputes. We don't reopen the merits of the dispute, provided the enforceable undertaking is in line with an AFCA approach, but we will look at whether or not the member appropriately remediated as they should have done under that remediation program.
Anna Mandoki is our senior manager up here in the Sydney office, who's been sitting here under the bright lights but not saying anything. So I thought, Anna, I would invite you to answer a question about will members be assigned an AFCA liaison officer to handle the cases that have knowledge of the industry?
Thank you, Philip. Yes, I've been feeling a bit decorative up here, I have to say. I usually talk, but then I thought, no, that's Philip's role. You look more decorative than I do, but there you go.
Oh, I wouldn't say that.
Yes, so I'm the senior manager here in Sydney, and I'm managing the office at the moment and assisting with the transition of the former CIO members and the former CIO staff across to AFCA. And we do, I'll just mention as well, we do have some staff from the Sydney office here towards the back of the room there. So if you are in the room here, then do feel free to go and introduce yourself to them and have a bit of a meet and greet later on. So the question was, will members be assigned an AFCA liaison officer to handle the cases that have knowledge of the industry? So there's really no change from the predecessor schemes in that when a complaint comes into AFCA, when it goes into case management, a caseworker will be assigned to that particular complaint. And then that'll be the person that you'll be dealing with going forwards on that particular complaint. And the caseworkers that we recruit, we obviously look for people who do have an industry experience and background and good knowledge and skills in that area. And then we fill in any gaps with some extensive training in terms of codes and all of that type of thing. So all the relevant industry codes we provide training on. So our staff are all very highly trained and experienced in those areas. Does that answer the question?
Yes. Oh, I think so. Does anyone have a follow-up? No. A couple of questions online and also previously around AFCA funding and things like, can we expect AFCA's fee structure to change from FOS in 2019? So the funding model is, as I said, it's on the AFCA website. If you're a FOS member, my understanding is that it's not substantially different. What it may mean for an individual member or in individual cases it may mean some changes. But if you do have any questions about that, I ask you to call our membership people or send them an email. And that was on one of those very early slides that I spoke to in the introduction. I can't get up here and say that it's not going to be different because I wouldn't want to mislead you. But if you do have any questions, please call that membership hotline.
If I can just add to that, the funding model that we went out with and consulted on was an interim funding model.
Yes.
And so that interim funding model is in place, I think, for the first 18 months, if my memory corrects me, but it's on those slides. And the philosophy is that the funding model is a little bit different for superannuation complaint trustees. So people for super complaints, they have a quarterly levy, which is different to the funding model that was from the pre-FOS and pre-CIO members. The reason being there wasn't enough time between authorisation and when 1st of November came to do a total rehaul. So what we would like to do is get all the dispute data in the door to work out where all the complaint resolution points are, how complaints are tracking, and then do a more informed and enhanced consultation after we've got some actual dispute data to be able to come out and get your thoughts. And then everyone will have experienced the new process. So that will be to be posted, I think, within the first couple of years.
Excellent. And Di, just while you've got the microphone, what's happening to all the stuff on the FOS and CIO website? All the published decisions and the like. Are they coming across to the AFCA website?
They are still going to be there. There will be a link on our AFCA website to have. I just had a meeting about this last week.
Excellent.
And you will be able to access all the predecessor scheme decisions and also superannuation complaint have their decisions on Austlii. So there will be a link to previous decisions that should be able to hyperlink you to the old websites. That being said, don't hold me to it. It was a meeting last week where we were trying to work out whether we hyperlink through our one or whether you go on the old one. But I think you'll be able to search on decisions, and it should be able to take you, if you put age in time, to those previous websites. So it'll be the CIO old website, FOS old website, and Austlii for SCT.
Thanks very much. There's a question here about whether the controls on credit listings also apply to the ATO. I don't know off the top of my head. They're not a member of FOS, CIO or AFCA, but and Rachel's shaking her head. I'm not sure which way she's shaking her head. So I can't really answer that one. I'm sorry. Just to show you, I don't know everything. I know I might give that impression sometimes, but it's not true. So, follow-up question for that around funding, about the cost of membership for credit representatives, whether that will change. Look, it's hard to say at this stage. That will go into the mix of that funding review in 18 months' time. So I wouldn't like to make a prediction about whether or not that will increase, decrease, stay the same. It will be a matter of review and consultation at the at that time. So good. I've done all the online stuff. Another one in the room, or you're breaching your one question limit?
Sorry about that. I just thought of another thing that we actually had discussed in our team. Is there any expectation that people are going to now be going to AFCA where they had unsatisfactory rulings from their previous FOS cases, and are there timeframes and are there limits for that sort of activity?
So if the matter has been dealt with by a predecessor scheme, it won't be dealt with by AFCA. But as Di said earlier, if there are new events or factors that have arisen since that time, then yes, we would look at that. Time limits, the same time limits will still apply, so similar time limits, so 6 years generally, but for matters involving regulated consumer credit, that's 2 years from when the product or the facility's been repaid. So that's quite a lengthy period. Those time limits remain the same, generally speaking. And so if there has been a previous FOS or CIO decision, then we won't be, absent any new matters, won't be re-looking at those ones.
Can I just add to that? Sometimes people seem under a bit of a misapprehension that we can just tell people at the front door of AFCA we're not even going to look at it. What we've got to do is assess that that's appropriate and assess that there is documentation to show there's been a previous decision or previous settlement. So if you know that's been the case, and when the dispute comes in and gets registered, that's when you can raise an objection to the jurisdiction. You don't need to wait the 45 or 21 days, and it can go straight to the rules team and it can be assessed there. And if it's assessed as previously been dealt with, there is no case fee incurred in relation to that complaint. But we can't stop progression of the dispute.
Yes, down the back.
Just a question around AFCA, or potentially your view on what could be potentially viewed as non-traditional forms of acquiring information for, say, credit decisioning. For example, we use an online tool called bankstatements.com. So rather than getting manual printouts of people's bank statements to make credit decisioning, we will utilise that tool where appropriate or available. And it spits out a different output of the data. So we're getting all the transactions and all the information, but it looks quite different to the traditional bank statement. And that has, I guess, been risen for us in the past as a concern or question rather. And I just wanted to understand your view on maybe those non-traditional or not so commonly seen forms of information to rely upon for decisioning.
I don't have an issue with it. there are some products I've seen, I don't know how the one you use works, where it doesn't really analyse expenses very well, so and that's a question of inputs. So we'd probably have a look at that to see how that was working. One of the biggest concerns around that is people disclosing their access login details to enable those sort of scraping companies to access their bank account details. That is a bit of a concern. I guess it will be less of a concern when we get to open banking next year. I guess one of the things that would be useful if people are giving out their password, that the company that receives those details, once they've scraped or got the statements, they then tell the customer they've finished and tell them to change their password, I think would be a nice, good thing to do to ensure that there isn't a breach. But I suppose if they are disclosing it and the company that gets that information somehow misuses that information, that company and maybe you might be liable for any misuse that happens, including, even though they've voluntarily disclosed, really they should expect that those systems are safe and are not going to be abused. So you want to make very sure that you're dealing with somebody very safe.
So you would consider them a valid source of information when putting together, say, an EDR response?
Yeah, if you can explain how it is that you've used it and why you think that gathering that information reveals their actual expenses, for example. I mean, clearly income is pretty easy to see from a bank statement. It's the expenses that get hard, and then how you categorise those into core and discretionary, and then what you've done with it. So in terms of getting the basic information, I don't have an issue with it. It's probably more, well, there's two things. One is how you've categorised things in the first place, and then what interpretation you've put on the information that you do get. So it's still, it's certainly a tool that you can use, and I don't have a primary issue with it as such.
Thank you.
And that brings us to 12:30. There's a couple of questions pre-submitted that we haven't got to. So if you are in the room and they're burning issues, we're more than happy to chat to you afterwards. And in fact, for those of you who are in the room, I'd like to invite you to join us next door, where we have some light refreshments. Now, Claire, what does that involve? Sandwiches, does it? Or, just a cup of tea? Or
No, yeah, we have sandwiches.
we have sandwiches.
And
Wow.
wraps.
Who'd have thought? So we welcome, for those online, if you're in Sydney and you're not too far away, please come down and join us. But for those of you who are in the room, please come and have a chat to both the people here and our Sydney staff down the back. We'd love to have a chat to you. We'd love to have a sandwich with you and answer those questions that you didn't want to ask in public. For those online, thank you for joining us. We look forward to having you join future webinars in the future. We hope you found it useful, and thank you everyone for coming.